Okay, so any, I don't know, general questions, comments before we get into talking about bonds and their bond prices? The most exciting of all discussions.
Just a heads up, I've got family stopping by to pick up my kids, and so my screen will stop record, or I'll stop the video and mute, but I haven't left. When that happens, I'm still here.
Okay, so we won't assume you're in the bathroom or something. We'll assume that you're
nope, I'm here.
All right. Or that you just got bored. You were like, screw these people, I'm out.
But I still want to look like I'm here.
Yeah, exactly. Just put up like a little cutout, a little cardboard cutout of yourself in front of the camera. I think that would work. Anyway, okay, so bonds and bond pricing. I mean, we could talk about other things, but I think this is the part that usually hangs people up in this chapter. I'll tell you, when I was studying for my Series 7 like brokerage exam, this was like the hardest part for me, because somehow I got through my undergraduate degree. It was called a business degree at Wayland Baptist University, and like never took an accounting class. So I just sort of like, I had done accounting because I grew up in a business, so I had done bookkeeping, but as far as things like bond premiums and discounts and stuff, like I had never even seen that. So I had to really sort of make it up as I went, and then finally learn it on my own. Because when you're working, I sold bonds for years with Edward Jones, and you kind of have to understand how they work. So let me share my screen with you. Let's see. I think it shared it. Oh yeah, and then when I go to do this, it's going to give me fits. And switch that around, and then I'll have to swap, and it'll be great. Okay, so I'm gonna just go up to the top of this here. So first of all, so recognize that all a bond is like, it's a loan, okay? So if I'm a business and I issue a bond, what that means is I'm soliciting a loan from other people. So instead of going to a bank and saying, hey, will you give me $1 million because I need to, build something or do something, when we issue a bond, what we do is we go to a bond, they're called a transfer agent, and we do the same thing. We say, hey, I'm trying to raise, several $1 million for a project or something like that. And I'd like to do this through bonds. So it's usually when a corporation, that's a corporate bond, or when a government, that's called a government bond, is trying to raise a big chunk of money fast. What they'll do is they will go to a bond transfer agent, and the bond transfer agent will structure what's called a bond issue, where in essence what they do is they reach out to their investors and usually sell them off in $1,000 chunks. And those investors can do 1,000 or 5,000 or 10,000 or whatever they want to. And so it's almost like crowdsourcing a loan, right? A whole bunch of people can sort of buy in at the level that they can afford to. And the bond will come with a guaranteed, what's called a face rate. That's an interest rate the bond will pay. And it will pay that face rate on what's called the face value, the amount that the person bought the bond certificate for. Or the amount that's on that bond certificate. And typically bonds pay interest semi-annually. So there's 2 bond interest payments a year. That's the norm. And so what'll happen is if I'm an investor, then what I will do is I'll invest my money into the bond, which means I'm lending my money to the business. Then every 6 months, I'll receive an interest payment. Then at the end of the bond's maturity date, or when the maturity date arrives, I'll receive my initial investment back. Okay. From the perspective of the business, what we do is we receive cash in exchange for a bond payable. Then every 6 months, we're paying out a cash interest payment. Then at the maturity of the bond, we're paying back cash for the principal amount. And so almost all the transactions are from the business's perspective. So we are the borrower of the money. The initial transaction will be our cash going up and our bond payable going up. Then we'll have intermediate transactions of interest expense and cash going down. And then we'll have a concluding transaction when we pay back the cash and the bond payable goes away. So that's I guess, bonds in a nutshell. The problem is this. Because bonds have a fixed face interest rate, and because they're marketable, meaning they can be sold anytime. So if I issue a bond and you buy it, which means you loan money to me, you can sell that bond to somebody else, okay? And then they would have the claim, and then I would have to pay interest to them, okay? So because of that issue, what happens is as interest rates fluctuate, the price or the face value of the bond doesn't fluctuate, so the market price of the bond is going to fluctuate up and down. Think of it this way. If, like, for this bond they have right here is a 10% bond. You can't get those right now, by the way. That would be really awesome. I would have all my money into 10% bonds if they existed. But the idea is if a bond is paying 10% and then the market interest rate drops to where all new bonds being issued are at 6%, then everybody's going to want that 10% bond. And so the price on my bond, the amount I could sell it for, is going to go up. So remember that market interest rate fluctuations are always contrary to bond prices. If market interest rates drop, bond prices will go up. If market interest rates go up, bond prices will go down. This matters to us as the business that's issuing the bond, is because often businesses that issue bonds don't issue them all at once. In other words, if I need to borrow $10 million, but it's on a 5-year project, I'm not going to borrow all 10 million and have it sit there earning no interest or anything. Instead, I'll borrow 2 million and do the first phase of the project, and then I'll borrow another 2 million. But the bond issue's already been created, so the face value and face interest rate of those bonds is already set. So in the intervening time, market interest rates are fluctuating. So sometimes we're issuing bonds at a price that is less than their face value, and sometimes we're issuing bonds at a price that is greater, okay? That was a bunch of mumbo jumbo that won't make any sense until we get into an example, unfortunately. All right, so here's the Deaver Corporation, or Dever, or we'll just call it the corporation. They issue 100 5-year, 10%, $1,000 bonds. So their total bond issue is $100,000, okay? And they're issuing them at 100. So this little number right here tells you the issue price. If it's 100, that means 100% of the face value, okay? If it's greater than that, like 101 or 102, we'd say that bond is being issued at a premium or at a price above its face value. And it's always expressed as a percentage of face value. And then if it's less than 100, then we would say that's being issued at a discount or at a price less than its face value. So for this example, we're issuing it at its face value. So all we're going to do for that issuance is show our cash going up by $100,000 and our bonds payable going up by $100,000. Piece of cake when you issue at face value or at 100. Sometimes they call issuing that at par, which means the same as its face value. Okay. So let's see. One other complicating issue is usually when the bond pays interest, it has, like I said, it pays twice a year. So what we're going to do is, so this bond, it looks like just pays once a year. Let me see what they're doing here. So yeah, so they're accruing that interest at the end of the year, where they took the face value times the rate times the time, which in this case is 1 year. And so at the end of the year, they're going to accrue that interest as an interest expense on December 31st and an interest payable. Then the next day on January 1st, they'll go ahead and pay that interest in cash. And so then they would debit interest payable and credit cash. So one other thing that always gets people on these bond ones is remembering that at the end of a fiscal year, we have to accrue any interest the bond has incurred up to that point, okay? So if the payment's date isn't until January 1st, well then on December 31st, we still have to record the interest expense for the year, even though we're not going to pay it till the next day. So there's how it would pay it on the next day. Okay, but it's not always the case that we're going to be issuing bonds at par or at their face value. So sometimes our interest rates will fluctuate down, market rates will fluctuate down, which means the bond price will fluctuate up, and we'll issue the bond at a premium. Other times interest rates will fluctuate up, which means bond prices will fluctuate down, which means we're issuing them at a discount. I'm not sure if this table helps anybody. Some people like to see the visual. For me, I just remember that there's a converse relationship, right? When market interest rates go up, bond prices go down. That helps me, but you know, whatever works for you. So here's an example. Assume on January 1st, Candlestick Inc. sells $100,000 5-year 10% bonds at 98. So 98 means 98% of face value. What that really means is they're going to get cash of 98,000, but they're going to have to pay back 100,000 when the bond comes mature, because they always pay back whatever the face value of the bond is. And they're going to pay interest 10% on that full face value each year. Okay. So the reason they're selling it at 98 is because interest rates have fluctuated up relative to this 10% face rate on the bond, making this bond less desirable than the new bonds the market would be issuing at the time. So to get people to sell it or to buy it, they'll sell it at 98% of face value, which will in essence give the new buyers an effective yield of higher than 10%, since they only paid 98,000, but they'll get 100,000 back. So they'll make a little bit better. They'll make usually what the market interest rate is. So when we issue it, it's going to look like this. Our cash goes up by 98,000. We're going to debit a special account called discounts on bond payable, and then we'll credit the bond payable of $100,000. So that's what it will look like to issue a bond at a discount. That $2,000 discount, we're going to have to amortize that off over the life of the bond. And so since it's a 5-year bond, every year, or usually at every interest payment, you will amortize a portion of that discount. And I'll show you that process in a minute. Okay. So this is what our bond will look like on our balance sheet. You'll see bond payable less the discount on bond payable. And then this number here, this $98,000, is what we would call the carrying value of the bond. Okay, so it's sitting on our books at $98,000, but we know when it comes mature, we're going to have to pay back $100,000, and that's that process of amortization where we're going to make this number slowly go away over the life of the bond. And I'll show you how to do that in just a second. So here's another example. We issue bonds at a premium. So assume that in the previous transaction, they issued them at 102 rather than 98. So that's 102% of face value. Another term for that is issuing the bond at a premium. So our cash would be 102,000. Our bonds payable would be 100,000, and we would credit the premium on bonds payable. So this would happen if interest rates, market interest rates fell, and so our 10% bonds were suddenly more attractive than the new bonds being issued at the market. So we could sell them for a little bit more than their face value. And that would in essence drive that 10% yield down a little, so that the people who are investing in it are going to have a slightly lower yield. So the amount that the market will force us to do a premium or a discount is usually enough to make our bond yield equal to the current market interest rates. That's really what's happening. I know that was probably just sounded like double talk, but that's just how it works. So that this existing bond will pay roughly what the new ones being issued are paying. Again, it will look like this on our balance sheet. And what that means is we have our bonds payable plus the premium on the bond payable gives us a carrying value of 102,000. We're going to have to pay back $100,000 at the maturity of the bond. So we're going to slowly amortize that premium off over the life of the bond. So recognize this. If I issue a bond at a discount, go back to that one, then in essence, what I've done is I've got $98,000, but I have to pay back $100,000. So in addition to the expense of the interest I'm paying every 6 months or every year, I have the additional expense of borrowing, cost of borrowing that money of that $2,000, since I only got 98, but I have to pay back 100. So when we amortize the discount, we'll be having additional expense. And we're going to consider it part of our interest expense because truly it's a cost of borrowing the money. In the case of issuing a bond at a premium, now I've got 102,000, but I'm only going to have to pay back 100,000 when the bond becomes mature. So this is effectively reducing the cost of borrowing money. I mean, I still have to pay the interest, but I'm going to have to pay back $2,000 less than what I got. So that's going to reduce the amount of interest I paid. And again, that'll happen during the amortization process. So here's what it looks like. By the way, if you have a question, don't be afraid to jump in. Sometimes you think, I'll ask that later, and then you forget. Also, you can throw it in the chat too, if that would be helpful. Because I'm just going. So Candlestick Inc. sells $100,000 5-year 10% bonds on January 1st for $98,000. So the same example we just had. So here's, and it says interest is payable January 1st of each year. So what they have to do to amortize that discount is they say, okay, it has a $2,000 discount. I divide that by the life of the bond, 5 years, and that comes out to $400 every time I pay interest, since this pays interest once a year. Okay, so on a discount, what we're going to have is the interest payable, that's the amount of interest we're going to pay, the discount of 400 on the credit side, and then our expense will be the whole 10,400. So it'll be the sum of all of the interest we're paying, and we figured that out by taking the face value times 10% times 1 year. That's the amount of interest for a year, plus the amount of discount that we're amortizing. All of that adds up to our interest expense for the year. So recognize that this amortizing, or this credit to discounts on bond payable, is just the recognition of 1/5 of that $2,000 discount as an expense during this year. So we'll be taking $400 each year over the life of the bond, and at the end we'll have recognized all of that discount as an additional, as part of our interest expense. So here's a little table that's confusing at first, but kind of makes sense once you kind of follow it. So at the issue date, we have, it's a $100,000 bond, so we have $2,000 of unamortized discount, and our carrying bond value, which is our issue price of 100,000 minus the discount, is 98,000. Then at the end of the first year, we have $10,000 interest to be paid. We have $400 in amortization, which is the $2,000 discount divided by 5 years. So our total interest expense will be $10,400. We'll have amortized now 400 off, so we'll have 1,600 left and have 98,400 in carrying value. And you'll see that each year the unamortized discount drops by 400 and the carrying value increases by 400 until at the end of the bond's life, or at its maturity date, the carrying value is going to equal the face value. And we'll have claimed all of that interest, all of that discount as an expense over the life of the bond. So that's the whole process of amortization and why we do it. What's interesting to me is, like, someone thought this up. Like, it's one thing to teach an existing concept, but like someone was like, well, we'll just do it this way. And apparently it's stuck. So good job on whatever person thought that up. So bond premium, same thing, $100,000. This one they sell for 102, which means we get 102,000. And so here's what we're going to do to amortize that. So we'll have interest payable. That's still $10,000. That's the face value times the rate of 10% times 1 year. And then we'll be debiting the premium on bonds payable, which will actually reduce our interest expense down to $9,600. Okay, so that's the process there. And so again, you'll see over the life of the bond, that carrying value, which will start at 102,000, that's 100,000 plus the premium, will slowly chip its way down to $100,000 at the end. And at the end, we'll have recognized all $2,000 worth of that premium. And the way we recognize it in this case is by reducing our interest expense. And so that's the process. Anyway, so that's kind of all I wanted to cover. I mean, you might have other questions, or we might look at some problems, but I really feel like this is the hardest concept in this chapter. Just not even because it's hard, but because it's new, because most people have never dealt with or thought about bond interest, like ever, because it doesn't come up unless that's what you do. I'll tell you, in the time I've worked in accounting, with the exception of the time when I was a broker selling bonds to people, like I've never really dealt with amortization. I suppose if I had a lot of people who invested in them, I would have to do that on their taxes, but I don't do taxes, so it's not really, except for my own. And I'm not a big bond buyer, probably because I'm still relatively young. It's usually old people buying bonds, but not always. Okay. Any thoughts or questions?
I just found it hard to, like, I don't know if it was hard to concentrate on it or just hard to get the concept to stick, because the first half of the chapter, the first couple sections of the chapter, I was like, yeah, this totally makes sense. And then I started reading the bond and I was like, I know some of these words, but not all of these words. It was almost like it was a whole new thing.
Yeah.
So
Snooze fest.
What's that?
It was a snooze fest. I was trying to stay awake reading about bonds.
gosh, yes, I thought I was the only one who thought so, but yeah,
No, I think everybody feels it.
And I could wrap my head around the math, which is very surprising. So I'm obviously learning something in here. But Michelle, go ahead. What were you going to say about it though? Because I wonder if we were on the.
I know, I think we're on the same page. I think it's just kind of dull. And that's the first time I don't find this class very dull, but this section is very dull. And I get the journaling portion because that's all pretty much the same. It has to,
Yeah.
even you got to match it up, and that part I get. I'm just finding the reading portion of this section. I've been stuck on 10.3 for like 2 days, and that's not like me.
I found I don't know if I'm overthinking the bond thing, but why? So if it was somewhere in the readings that they were talking about the bonds, and then it was costing $100,000, and then they would pay, basically $152,000 when they're done with it because of the interest and everything. But who gets the? I guess from a banking standpoint of view, maybe I'm looking at it and I need to not do that. I was really trying to understand that, because then I thought, well, is it only costing somebody the $50,000? Am I making sense a little bit?
Yeah, I think maybe. I mean, anytime we borrow money, it costs us something, right?
Oh, yes.
Right. And so, and honestly, whatever that cost
Don't
is
worry about it then. I'm good.
interest expense. And
Yeah.
so, the only thing different here from like a regular loan is the fact that sometimes we issue at a premium or a discount. And so that's going to affect the total amount of expense. Rather than taking it as a big chunk at the end, we spread that premium or discount out over the life through the amortization process. That's really the only thing that's different than other notes payable. Other than a lot of time notes payables will have compounded interest, whereas a bond is straight interest, simple interest. I don't know if that helps.
I don't know. Let me grab my book, because I don't.
So I read yesterday that Mark Twain, when he read the Book of Mormon, he called it ether in print, meaning he thought it was incredibly boring. And so, but maybe this is more boring. I don't find the Book of Mormon boring anymore. But when I was a kid and first trying to learn about the church when I was 17, it wasn't a comic book. I'll tell you that.
You're saying one man's ether is another man's caffeine? Is that what you're saying?
Well, yeah, exactly. So, so maybe like I'm just like way too into this, and everybody else is like, this is the most miserable thing on earth, and I'm like, bond premium, it's so exciting. Anyway,
Go ahead.
anybody else? Well, Monica's. I think were you looking something up in particular, Monica? Okay. Anybody else? Other thoughts or questions or problems that we want to look at? You guys are so smart. See, you don't even need help.
Oh no, you saw the grade on my last exam. I am not one of the smart ones.
That's a rough exam. It was.
It's the rest of you he was just talking to.
Wait, so are you saying the last exam was pretty rough, or just all of them?
Well, what's interesting about it what's interesting about the last exam is the average score was roughly in line with the average score on the other exams, but several people who usually do decent kind of got hit hard on it. You know, and so what that means, I'm not sure. But said that the mean score was about the same. I think the mean score, if I drop out zeros for the people who just didn't take it, because by this stage there's a few people that are like, I'm done with this class. So to be a fair mean, right, you have to drop out zeros, and the mean score was something like around 74%, something like that, which is probably what you would guess on an exam. It's somewhere in the middle. And so that didn't really change. I think it was like 72 or 73% on the last exam. So, and yet, like I said, several people who, you know, I got a couple emails where people were really frustrated by it. And actually there were, I don't know, there was a handful of people who typically score low who scored better on it. So I don't know. It's so hard to read into that broad data like that to know if it means anything or if it's just, you know, sometimes we have a bad test, you know, unless you're one of those people that always is good at tests, or one of those people that's always bad at tests. You could know have the best knowledge on earth and still struggle. That happens to people. Monica, did you find what you were?
I did.
Okay.
So it's on page 491 of the book. It's illustration 10.8. I don't know if that's going to help, but it talks about bonds issued at a discount. And so it shows the annual interest payments of 100,000 times 10% equals 100,000, and then 10,000 times 5. And basically it shows 50,000, and then you add the bond discount of 100,000, subtract 98,000, and that gives you 2. And so it says total cost of borrowing is 52,000.
Okay, let me pull it up. I just grabbed my book and I was like, I flipped to 491. It was my business statistics book, and that was something radically different than what you were explaining.
Yeah. And no,
maybe even worse than this class. All right.
I don't want to take statistics again.
All right, so I'm looking at bonds issued at a discount. Annual interest payments is the one right in the middle of the page.
Yes, sir.
So annual interest payments of 100,000 times 10% equals
I'm more
10,000.
confused on total cost of borrowing. So is it costing just the company the 52,000? I guess because for some stupid reason, I was thinking somebody was only paying half of the bond, and so they're getting 100,000 bond for 52,000. I'm literally thinking of it as a savings bond, and I think that's what I need to stop.
Yeah. So yeah, it's nothing like a savings bond. So yeah. So what this means is, for example, the one we're looking at is that they're going to make $50,000 in interest payments over the life of the bond.
Okay.
Plus the fact that they only got 98,000, but they're going to pay back 100,000 at the maturity is an additional $2,000 in interest expense. So the total cost to them is 152,000. Okay. I mean, sorry, the total cost is 52,000, but they'll pay back 152,000 what they borrowed plus 52,000 in expense.
And okay, and that's fine. That's better. I feel better saying it out loud and talking about it. It makes more sense now. And like I said, I think I was just really overthinking it.
Yeah, those savings bonds, so like government savings bonds are their own kind of like beast, right? Where you purchase them at a discount. You know, you pay $52 or $78 for one, and then at maturity it's worth 100 or something like that.
25 years later.
My granny used to buy me those, and
yeah,
when I got older, I was like, "That's so nice of you," but like interest yield, you could have bought me like Microsoft stock. But
you should see the interest. Some of them still yield. Actually, we've seen a bunch lately being redeemed.
I was just thinking, if my grandma had bought me Microsoft stock starting in 1980 or whenever you could have bought it in the same amounts of the savings bonds, I think I wouldn't need to be employed right now. But I'm so grateful to my grandma for thinking of me. Don't get me wrong.
I'm so grateful she didn't, because then we'd be stuck with some crummy teacher.
Could be one of those rich guy teachers that's like, I just do this because I love it, instead of like, I got a mortgage to pay, man.
You have to be here.
have 8 children. Anyway, okay. Other questions or other or specific problems maybe to look at in the chapter? What?
I was talking to my dog. Sorry.
Oh, okay.
He's skittish. I apologize. Forget this was on.
So Angelica, she wasn't able to be here tonight. I think she works at this time or something. She's not able to be here. She'd asked me to look at the 2 problems that were they're actually in the homework support. I saw that some groups had like nobody post in there or like partially post in there. So I've gone through and I have shared, you know, what I try to do is if another group has shared one that if there's a group that doesn't have someone sharing, I'll try to steal that from someone else's group and share it. But so probably what I'll do, since everybody's group has those, is I might still go over them at the very end. That way people who want to duck out can, since that information is already out there and available. But so you don't have to sit here with us, but I'll still walk through it real quick. So hopefully that will help Angelica when she's able to look at this. But so other than that, we're in good shape. We're in the home stretch. A couple things to remember. Number one, like extra credit has not been added in yet, because the way Canvas is, if I try to add it, then it looks like it's dropping your grade, because Canvas works on like category basis. And so each category has a percentage that's allotted to the total score. And until the last category is put in, the extra credit category will look like it's counting, because you don't have 100% of the categories applied. So I just leave it off of there. So if you've been doing the extra credit, you can expect your grade in the class to jump up some at the end. Not a lot though. Unfortunately, I'm statutorily limited. It's not really a statute. By rule, I can only give like 1% of the total grade. But a lot of times that's enough to bump you a minus or something like that. Or, you know, I'd much rather have a B- than a C+ as an example, but it's not a lot. But know that that's out there. The other thing is, know that like the exam grade is made up of, it's an average of all the exam grades, and then that accounts for 50% of your total grade. So if you have like a couple bad exams, then having a good exam can really bump you up fast. In other words, if you're averaging 60% on exams and then you pull off, you know, a 75, that actually makes a pretty big jump up in the grade. And so just, if your grade's lower than you'd like it to be, don't give up hope, I guess is what I'm saying. The mathematics of it make people so they're often pleasantly surprised at the end, although not always. The final exam is 10%, I believe. I have to look in the thing again, but I believe it's 10%. And that, you know, that has an impact as well. So, but like I said, history has told me over and over that people tend to score pretty close in line with what they're doing on the exams. So that may scare you or encourage you. I'm not trying to discourage, but you would think, I guess most people think the final is going to be harder because it's cumulative, meaning they're going to miss more, but that's just not what I've seen. People tend to do similar. Try to think of anything else that's worth mentioning at this point. I don't think so. I mean, I don't have much more for you other than if we're finished up, I will do those problems for Angelica. Here is exercise 10-13. This one is, mine's called the Oriole Company, not Oreo Company. That's a different company. Probably far more delicious than an Oriole, although I've never eaten one. Anyway, the Oriole Company issues $550,000 10% 15-year bonds at face value. This is that thing I'm doing, huh, Monica, where I go really fast. Sorry, I will slow down. I just get in a hurry. So the first thing we're supposed to do is prepare a journal entry to record the issuance of the bond. So since we're doing it at face value, our cash will go up by $550,000. And our bonds payable, which is a liability account, so it will be credited or go up by $550,000. And then in the second part, it says prepare a journal entry to record the accrual of interest on December 31st, 2017. So it looks like this bond just pays straight once a year, which is nice and easy for us. So we'll take $550,000. That's the principal or the face amount. times the rate of 10% or 0.1 times the time, which is 12 over 12 or 12 months out of 12 or 1. So it's going to be $55,000 in interest expense and then $55,000 in interest payable. Part C says prepare the journal entry to record the payment of interest on January 1st. And so that is going to be just that we're going to debit the interest payable account now. So that'll go away and we'll credit cash. So our cash will go down as we pay the interest. And then finally, let's see, prepare the journal entry to record the redemption of the bonds at maturity. So on that one, our bond payable, which was the liability, it had a credit balance, will now debit that. So the bond payable will go down to 0, and then we'll credit cash, meaning our cash will go down by $550,000 to pay it off. So that's a pretty straightforward bond issued at par or at the face value sort of scenario. We get cash, we owe the money, we pay the interest, will be accrued at the end of the year, then we pay it on the interest date, and then we pay our cash and the bond goes down. So that one is pretty straightforward for us anyway. Okay, so 1012A is a little tougher, or it might be a lot tougher. So this is Laverne purchased a new piece of equipment to be used in its facility. Apparently that's the name of the company, not a person. $405,000 piece of equipment was purchased with a $40,500 down payment with cash received through the issuance of a mortgage. Okay, so I didn't go over mortgages earlier. Now I see things coming in the chat. Is this relating to Jessica's conversation, or is these questions I need to stop and address?
Yeah, just class stuff.
Okay, just don't want to make sure. I want to make sure I'm not missing something. All right.
We're gossiping about you, so just please ignore it.
No, you can gossip about me all you want, because sticks and stones, all that. Okay. That's not real life, right? I don't know if you're like me, but there's days like when you read like your student evaluations, there's days when you're like strong and you're like, okay, that's good advice. Like I can make some changes based on that. And there's other days when you look at them, you're just like, I can't look at them today. It would just crush my little soul. Anyway, so you have to be tough. So the day I was called as bishop, a guy comes to my office and he goes, hey, I just think you need to know that my wife really hates you and she cried when she found out that you were going to be our bishop.
Oh my gosh.
And so that was kind of brutal. I guess what had happened is years before, when I was a counselor in the bishopric, she had come to me wanting to be released from her calling. And I thought that I had had a good conversation with her, encouraging her to maybe stick it out and pray and see how she felt. And she felt I'd just completely blown her off and not heard her pain. And rather than ever talk to me about it again, she just like hated me after that. We did reconcile. It was maybe it was a good thing he told me so bluntly. It gave me a chance to visit with her, and either that or maybe I talked to her and thought I'd really worked it out and she still hates me. That's possible too. The last bishop I worked with told me that he figured if he just offended 20% of the ward each year, that in 5 years he would offend everybody. And so that was the goal.
Like
Anyway, okay. So you can talk about me if you want, I guess is what that was all about. All right. So it's hard. You don't ever want to hurt other people, and to find out like you had is really that's rough on the.
I found that out one time that a woman had like hated me for like 7 years in her ward, and I'm a pretty easygoing person. I was like, well, why didn't you just say something? Like, you've been mad at me and you missed all of this for like 7 years. And
yeah.
You have no idea what you've been missing. Like, I'm not cocky generally, but I was just like,
yeah. Like, people are complex. All right. So the way we go about this one is we say, hey, at the issue date, I have the cost of the equipment minus the down payment, so $405,000, minus the down payment of $40,500. So I'm going to finance $364,500. So that'll be the beginning principal balance. And then what we have to do is recognize that with mortgages, the cash payment's always the same. This would probably be right up Monica's alley. She probably deals with that in banking. So the payment is consistent. She pays an annual payment of $90,291. I say she, it's a company called Laverne. I think it's gender neutral. Corporations usually are. Anyway, so Laverne, the corporation, pays an annual payment of $91,291. So to figure out our interest expense, we take that principal balance minus $364,500. We multiply that by the interest rate, and that's going to tell me how much our interest is for the year. And then the difference between what the cash payment is, so the cash payment minus the interest expense is going to be how much principal the loan will be reduced by. So I would take $91,291 minus the interest of $29,160. That's going to be my principal payment for that year. And then subtract that from my principal at the beginning of the year. And that will give me the new principal balance, $302,369. Then I'll do the same thing. Remember, my payment's going to be the same each time. So to figure out my interest expense for the year, I'll multiply that times the interest rate. And it's going to tell me to round. Yeah. So that's $24,190 in interest expense. Again, subtract that from the cash payment to give me the amount that's applied to principal. And then subtract that principal reduction amount from last year's principal, which will give me the new year's principal. Multiply that by the rate to get the interest expense, so forth. And I just carry that forward. I end up with this little $2 here because of rounding. And you'll see that happens, right? When you call for your payoff amount, it'll be a little bit more than you think, not because of rounding as much as by the fact that they're applying their interest on a daily basis. Most lenders are. So that's part A. So then part B tells us to prepare the journal entry for December 31st, 2017. That's this at the end of this first year. So what we're going to show is that our cash is going down by $91,291. Of that, $29,160 is interest expense, and the remaining $62,131 is a reduction in the principal of our mortgage payable. So that's the journal entry. And then part C, it's just going to say, well, what does your balance sheet look like after that December 31st, 2017 payment? And this is the tough part. This is the part that gets everybody. Because what we have to do is say, okay, current liabilities are those liabilities that are due within the next year. And then long-term liabilities are those liabilities that are due some way further out than a year from now. So after this first year, I owe $302,369 still on this note payable. $67,101 of it is going to be paid next year. So that part is the current portion of that note payable. And then the remaining $235,268, that's going to be long-term note payable. So we're going to list the amount that's due, the principal amount that's due in the next year under our current liabilities, and then the long-term portion under the long-term liabilities. And that, if you think about it, any long-term loan, if you make annual payments on it, is going to have a portion that's current or a portion that's due within the next 12 months and a portion that's longer term. All right, that did go kind of fast, and I apologize if but hopefully, I know some of you have worked through this already, so sometimes it's valuable after you've worked through something to have to like talk through it. And you're like, oh, that's where I screwed that up. Or like, oh, I got it right, but I didn't actually connect why it was right. So any questions or thoughts or, I don't know, other things?
If I need it slower, I'll watch the other video that is apparently slower. Or I'll hit pause.
What's nice about videos is the ability to roll back, right? To be able to be like, wait, what was that part? Wait, what was that?
I do that a lot on, and even the, I know we complain about having to make the videos, but they are sometimes helpful. A couple of weeks ago, I kept getting stuck on one question and somebody had done a very thorough job on their demo. And I was like, oh my gosh, thank heavens that they were super thorough, because I got stuck and it was one that we didn't have a video attached to it. You had not actually done a video to that one. And They did a great job, so it really helped me out. There was one part I kept getting stuck on, and I kept pausing it, and it was like a 10-minute video. So when I saw it, I was like, what the heck, a 10-minute video? What is that? But I was glad he had done a 10-minute video, because it was actually ending up being very helpful. So yeah, you can roll it back and fast forward through it. And
My daughter, who's on a mission, describes any video that is longer than 3 minutes as, quote, gross. Hey, for family, let's watch this 4-minute video. 4 minutes, gross.
As an old-time scouter, Baden Powell, who founded scouting, said that any scoutmaster who has a scoutmaster minute that lasts longer than 3 minutes should be shot.
Which I guess is worse than being called gross. So anyway, all right. Thanks for that, Jeff. Yeah, Baden Powell was like, let kids play and have fun. And the BSA certainly got to where that was not what was going on. It was frustrating at the end there. All right.
The YouTube video for that question, Brother Fox does it on Excel too. So he kind of shows you how to take a shortcut with some of it, but then he goes through like every single thing too, if that makes sense. I don't know if you're a whiz at Excel, but it was helpful.
Oh, I love Excel.
Anyway, yeah. So like seeing it that way too, I think is helpful.
Yeah,
So
I found
like
help watching the videos on there too, on that extra page.
Yeah, and just like click and drag is really nice when you set it up the right way. So, and I was too nervous to trust it, so I like went in and did every single equation in every box. But
the proper term for what Excel can do is sexy, not nice. It is.
Yeah, I'm like that savvy with Excel, but I feel every time I learn something new, it's great. And I took intro to Excel and I learned a lot. And that whole saying, use it or lose it, applies, because I don't really use it. So it's just, you know.
If you take Business 115, I think it's the Excel like beginners class. It'll teach you everything you want to know and a little bit more, and then you'll just love it so much. And it's just super easy class.
I'll have to look into that.
Everybody needs a super easy class sometimes.
You really just like follow
if you figure out which ones are that way, right? So you would like pair them with the hard ones. So you have like your cake class and then your hard class in the same semester. But
anybody that's on the BYUI community Facebook page, that's that's all they're talking about. Okay, tell me how the workload is for this class, because I got to balance my semester. Yeah.
But people have been getting real sassy lately, and I've actually chimed in on a couple of comments.
Oh yeah. So you might have seen my. Who cares? Just.
Oh yeah, I've done that. Yeah.
All right. Whoa. Man, it sounds like a fight over there. It's like a blast.
I will throw this in.
Actually, we're
it's been actually pretty bad lately.
We're supporting the folks that need the
I've never looked at it. It's like, don't read the comments. I think same thing. Like, I don't go to my own instructor, and I don't. None of that sounds fun to me.
Yeah, you're not allowed in because you're an instructor.
What I could say about it, my plan has always been the same. I go and I find everything I can on the Rate My Professor site, on LinkedIn for profiles, and I make a list from that, and then I take it to the Lord and pray. And I have never had a bad instructor doing it that route. In every instance, the instructor I get is someone who can teach me. And I've had through the years instructors that were great instructors, but not for me. But taking it to the Lord, I've never had a bad experience. I've had bad grades, but that's on me. It was not because of my instructor. And so Brother Fox, I appreciate that you are an answer to my prayer in this course. Now it's still on me, but I do learn from you. And
Jeff, that's way too logical. We can't be doing that.
Thanks.
That's I think the approach to everything in life. Let God prevail.
Yeah, and yet, why is it so hard, right? Like, why do we, like, it really is, honestly, right? You study it out in your mind. You avail yourself of the data that's available to you to the best of your ability, and then you take it to the Lord. And yet we still sit there and kick against the pricks and fight against the Spirit. And so if I don't know why what it is about the human existence that makes us so stubborn. But then again, if we are sitting here among potential gods and goddesses, I guess we wouldn't want people who too easily swayed. I think stubbornness can be a strength when it's used appropriately too. But right now, I think we're just petulant children, and I'm hoping God looks down on me like I look at my 4-year-old granddaughter, like, so adorable, but he's going to grow up not the way I sometimes look at my teenagers, where I'm like, I'm just going to knock his head off. Like, I don't need Israelite type smiting happening to me, but I think I'm pushing him sometimes.
Oh.
Steady the arc.
I envision putting her head through a wall sometimes. Yeah.
How old is she?
She's 21.
Oh, okay.
I actually heard through the grapevine she might be moving back home in a few months, and I'm like, I'm sitting in what is her room, which is now my craft room, and I'm thinking, where am I going to move everything from my craft room into our office? Because, yeah.
Just take her on a tour of the house and let her see how excited you are to have a craft room.
She knows. Yeah, she knows. Yeah.
And then say, well, we do have that old tent that we used to camp out in. So I guess there is a place for you. We'll give you a key so you have indoor plumbing.
The backyard's pretty big too. It'll work.
Yeah.
You're in an old conversion
Just
van.
designate a corner of the yard. You don't need plumbing. All right.
Thank you all.
All right. Thank you very much, everybody. Anybody after that nice conversation about kicking our children out, feel like offering a prayer?
I'll say it.
Okay.
All right. Our dear, kind, and gracious Heavenly Father, we're so very grateful that we can come together this evening and meet with Brother Fox, and we're thankful for him to be able to have the knowledge that he does, and that he goes above and beyond and makes the effort to ensure all of us are able to understand the lessons. Heavenly Father, we ask thee, as we continue to finish out the next couple weeks, that you can help us continue to grow a better knowledge and understanding of the accounting homework and skills that we are learning, that we can be able to retain the information, and you can help us be able to take those skills and be able to be successful on the tests. And Heavenly Father, we ask thee to please watch all of us as we go about our duties this weekend, that we may all be able to go to and from and return home safely. And we say these things humbly in the name of Jesus Christ. Amen.
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 Thank you.
Thank you, Monica.
Isn't it great to know that the parenting's hard for everyone?
Yes, it is.
Even people
Well,
who are really great people sometimes want to smack their kid.
according to Enoch, God wept over his children. So I think it is hard for everybody.